Hi everyone, let us discuss about foreign exchange rate determination. In previous session, I just mentioned exchange rate and different types of exchange rate, foreign exchange rate. Now, we will be discussing about foreign exchange rate determination. The foreign exchange rate is determined mainly by two factors, namely long-term factors and short-term factors. What do you mean by long-term factors? Factors which will impact for more than 1 year is called as long-term. It may be for 5 years, 10 years. So it will have a long period to show the impact on the exchange rate. Short-term factors means any change determination in the exchange rate, change in the exchange rate will be reflected within a year, say within 12 months. So that those factors are called as short-term factors. So first let us discuss about long-term factors. Long-term factors include, first is balance of payment, strength of the economy, interest rate, inflation, money supply and national income. Now let us study one by one in detail how these factors, these long-term factors will impact the exchange rate determination. Exchange rate determination means how to fix the exchange rate. While fixing the exchange rate, what are the factors that will influence in giving value to the currency? The first one is balance of payment. Balance of payment is nothing but the difference between all the money inflows into the country and outflows out of the country. That is, all transactions, goods and services that are traded within the country, between the countries are called balance of payment. So how much inflow of money has come into the country and how much outflow of money out of the country will determine the balance of payment. These financial transactions to determine the balance of payment includes the major participants like individuals, firms and government bodies. All these people will determine the exchange rate on the base of balance of payment. So balance of payment consists of three components, mainly current account, capital account and financial account. All these factors will be explained in the next session, current, capital and financial account. I'll just brief it. Current account is all the transactions, the goods and services that are imported and exported. Trading happens will form part of current account, which is for period of 1 year. Capital account is long-term assets that are involved in the transaction, investments, etc. Mainly the current account reflects the country's net income, while capital account reflects net change in the ownership of nation assets. So it mainly depends on the long run. So balance of payment will determine the exchange rate. Second is strength of the economy. Very important. Any country's exchange rate will be dependent on the strength of the economy. If the economy is good and very strong, definitely the value of the currency will be high. If the strength is low, then the value will reduce. So strength of the economy will determine the exchange rate. That is, the balance of trade and balance of payments should be very good in a country. Definitely that country's currency will have a good exchange rate in the global market. The third is interest rate. When the capital is attracted towards currencies which are yielding high interest rate, that will definitely determine the exchange rate of the country. So when there are more investment that is flowing into a particular country which gives them a higher rate of interest, that country's currency will have an impact in the exchange rate due to the interest rate. The fourth one is inflation. How inflation will impact on the exchange rate. Higher the inflation, it reduces the value of exchange rate. So when there is high inflation in the country, the currency will attract less. Others will not come forward to buy the currency because the value would have depreciated. The currency would depreciate against other major currencies. So inflation should be always at a particular rate. So the stability of inflation is very important. It should be in control. That's the reason why all central banks of the country will always control inflation, so that the currency value will also be stable of any country. So inflation will have an impact on the exchange rate. The fifth point is money supply. How money supply will influence the exchange rate. Increase in the money supply will cause inflation. When there is more inflation, then the value of the currency will come down. When there is more money supply, it will have a negative impact on the exchange rate. So money supply also will determine the exchange rate. The last is national income. How national income will determine the exchange rate. Any country with a good income definitely will lead to it will lead to increase in the investment as well as consumption. Therefore, that will have an impact on the exchange rate. Any country's national income is high, definitely that country's currency will have a greater value in the global market. So, these are all some of the long-term factors which will impact the exchange rate. Now, coming to the short-term factors. The first factor is central bank intervention. How central bank will intervene in determining the exchange rate. We have already discussed about this in the previous sessions. When there is fluctuations in the currency market, when there is fluctuations in the value of the currency, central bank will intervene or pitch in, and they will try to conduct open market operations by selling and buying the foreign currency in the market. This will have an impact on the exchange rate. So this is done only for a short period of time until the currency value comes to stability or the currency is stabilized. The second depends upon export receipts and import payments. If exports are more than imports, definitely the value of the currency will increase because there is favorable balance of payment. Where the country is receiving more foreign currencies, definitely that country currency will have more value. More imports will reduce the value of the currency. Therefore, export and import will have an impact on the exchange rate. The next one is foreign investment flow. It is nothing but foreign institutional investors. These FIIs who play a very important role, that is portfolio investment managers. When there is more of portfolio investment inflow, then the currency value will increase. When there is more outflow, currency value will decrease. So FII, foreign institutional investors, they play a very important role in determining the exchange rate of the country. The fourth one is political factors. Very important, though it will not have too much impact, but still it will impact on the exchange rate. It could be during the war, announcement of election results, suddenly the oil prices, if oil prices increases in that particular country, it will have an impact on the exchange rate. So people might doubt whether there is stable political intervention in the country or not. Political factors that are there. So if the government is stable, definitely people will have confidence on the government and they try to invest their money in the country. Then there will be demand for the currency. The fifth one is speculation. How speculation will impact the exchange rate. As all of you know that if any trader creates artificial demand by buying a particular country currency in large number. That is, when they start buying aggressively, definitely the value of that currency will increase and the exchange rate will increase. So, due to the speculation also, too much of fluctuations in the market, this will also have an impact on the exchange rate determination. The last is capital movements. Capital movements include FDI, external borrowings and assistance. So, the movement in external borrowings will have a favorable impact on the exchange rate of the country. So, when we start borrowing, we will be investing in it in some other country. Definitely that exchange rate will increase, the value of the currency will increase. So, these are all some of the short term factors. Thank you.